Hello and welcome to the Premium Account Investor Signals Market Update for May 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and the current licensed securities and derivatives advisor. The format for today's presentation: quick view of the macro update driving equities. We roll through the ASX top 50. We look at the trend between the FY 2015 earnings and dividend yields opposed to those coming into 2016 and really try to identify in what is a relatively fully priced market which companies provide a defensive mixed to add to portfolios, but at the same time provide some opportunity for some capital growth over the next 12 to 18 months. We tie that in with the technical trends, which is a theme that we picked up in last month's recording. So we revisit some of those technical trends that we've been looking at. We discuss portfolio allocations and conclude with the short-term market outlook. The Investor Signals Premium Account service is based on a model portfolio of ASX top 50 stocks. We utilize call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, trying to generate above average cash flow through the dividend yield and the option premium, whilst focusing on some capital growth. The investment strategy is managed under a strict investment mandate, therefore suitable for self-managed super funds, and importantly, the assets remain in your name. If you'd like to know more about the Investor Signals Model Portfolio Service, please contact me on the phone number or email on screen there. Okay, up on screen now you see a chart of the Dow Jones, and just to recap sort of the commentary from the last recording, over the past few months our view generally has been that the US equity market's fully valued. A couple of things sort of feed into that view. Obviously the fall in oil price means that we've seen a contraction in S&P 500 company earnings that are related to the oil industry. We've seen a high US dollar eat away at the reported earnings for large multinationals that are returning offshore earnings back to the US, and those factors combined with the low GDP or economic growth that the US has been through during the December quarter and again in the March quarter. Now, some may say that's just simply, it's a recurring pattern where these cold winters have a negative impact on US economic growth. We certainly saw that last year. If we'd expect to see the same pattern emerge this year, we would be looking for a significant pickup in manufacturing and economic growth in the US throughout the June and September quarter in order for the US to reach any sensible growth targets that have been applied by economists. And so when you look around globally, global GDP numbers are running well below trend, global inflation levels are running well below trend, and equity markets and asset prices are very much being supported at present by the ongoing quantitative easing. Largely the US has stopped, and obviously Japan and Europe have really picked up the baton to run with there. I think sort of what that creates is an environment where we're still seeing fairly weak numbers out of China, we're seeing weak numbers out of Europe, and an expectation that US growth reaccelerates in the quarters ahead. That all being said, when you put some numbers on where company earnings are at, S&P 500, stripping out the oil and gas sector, still should deliver about 7 or 8% earnings growth over the next 6 to 12 months, and that's on an annualized basis. When you factor in the earnings drop off in the oil and gas sector, the headline number becomes a negative, where S&P 500 earnings are likely to deliver probably minus 1 or 2% growth. But again, I think if you strip out sort of the concentration of those oil names, focus on industrial technology, banking, finance, etc., there's still a reasonable level of underlying growth there in the US market. And I think for that reason we maintain a buy on the dip strategy. I think any weakness that we see in equities over the coming period, we would encourage that as an opportune time to add positions back to the portfolio. And during today's recording, as we roll through the top 50, we'll focus on what names we think are best on the watch list or added into portfolios on any weakness. Before I jump into the XJO, let's just have a look at the 10-year bond yields in the US. For some time now, I've been sort of indicating that we really want to see probably a breakout of this lower low structure that we're seeing in the yields. I think if it gets to a point where these yields continue to trend too much lower, obviously that flies in the face of the Federal Reserve's intent of raising interest rates. And I think in some ways a trend towards normalization in interest rates and very slow gradual increases is ultimately what the economy needs over a 5-year period. So one of the benchmarks just to keep an eye on there is these yields on the 10-year treasuries. They're trending back up to resistance at around 2.2%. In the months ahead, we'll continue just to revisit this graph to see whether we actually move into a period for the first time for a while where the market actually breaks to the yield breaks to the upside and we start to get a gradual higher high and higher low formation in the yields, which would begin to feed into a view that the Federal Reserve's probably moving into an environment where they can gradually start to increase rates. If you look at what happened, say 12 months ago, the market started to get bullish on a US recovery and interest rates moving higher, but ultimately the strength in the US economy and the labour market simply wasn't there, and those expectations fell away again. We're probably at a phase now not dissimilar to where we are back here, where there's a building expectation that the economy is going to be strong enough for rates to gradually rise. So again, just something there for us to keep an eye on in the months ahead as a reference point. Okay, moving on to a graph of the XJO. Similar story here for us in that the industrials, we've seen ANZ, we've seen Westpac deliver their banking results this week. Westpac delivered fairly benign earnings growth on the same time last year. ANZ delivered about 5% growth. A big part of that came from their Asian strategy. We have NAB reporting. We have CBA reporting today, I should say. We have NAB reporting Thursday, and we have Macquarie reporting Friday. So interesting week for the banks and financials here in Australia. Likewise with our market, if you strip out resources and oil and gas, we know over the last 12 months and in the 6 months ahead, those numbers are going to be pretty awful. Looking at REITs, looking at financial services, looking at industrials, telcos, etc., healthcare, we're delivering still reasonable levels of growth, and they're the names that as we roll through the charts today we'll have a look at, focus on what the forward earnings growth is likely to be, have a look at where the dividend yields are and try to identify which names we want in portfolios. I think the picture is very similar in that we're probably likely to come back down, maybe test 5,600 on the XJO. I think we bounce along sideways there for a while. I think it's not until we start to see better data come through from the US as they move into their summer. We would want to see Chinese manufacturing pick up off the back of slight improvement in Europe, and then that might set the environment for an ongoing recovery in equities towards the back half of this year. Short term, I think it's more of a case of identifying these quality names, buying them on a pullback, and maybe even taking profit on any sort of rally in the order of 5, 6, 7%, as we're probably in a fairly tight consolidation band over the next at least 3 to 6 months, I think, with maybe a rally in the back half of the year. Okay, on that note, let's move straight into the top 50 and we'll have a look at some of these valuations, dividend yields and earnings growth outlook. AGL, so this is a name that we bought at lower levels here. We've taken profit just recently at $15.50. In saying that, I don't think there's any major risk to the downside here in AGL. I think it could easily just simply bounce around this $15 level. We'd certainly be buyers again at $14.50, up at around $15.50. I think it represents reasonably full value. And to give you some numbers on that, allowing for around 7% earnings growth, 8% earnings growth in the 12 months ahead, the stock trades on FES 16 numbers at 4.37% dividend yield and 14 times earnings. So I really think it's in the sort of a pocket of fair value here at around $15. It's a buy at $14.50, sell at $15.50, or alternatively, just simply go out, sell a covered call, get the extra income and collect the dividend there on AGL. But we're pretty comfortable with keeping a focus on AGL in portfolios, and we continue to look to add that at the right opportune time. Asiano, look, we continue to keep this one on the watch list on forward earnings growth of about 10%, which is probably a little bit above where the company's indicated that maybe around 5% where the earnings growth is. So analysts are a little bit optimistic here that Asiano delivers higher growth than forecast, but around 4% dividend yield, just under 4% dividend yield on the basis that the company delivers somewhere between 5 to 10% earnings growth in the 12 months ahead. I think it puts it fully value. I think Asiano, again, at $6, we're happy to take a look at it on any weakness over the next few days or week in equity markets. Amcor, 7 or 8% earnings growth, beneficiary of a lower Aussie dollar, allowing for around 8% earnings growth. The stock trades on a forward yield of around 4%. So again, it's in the pocket of fair value. We're a buyer down here at, say, $13.50. We're a seller up at $14.50, or alternatively, go out, sell the covered call, collect the dividend and the call option. But Amcor's a good addition to portfolios and comfortable sort of chasing that on any pullback at the moment. AMP not doing anything there, still have concerns around the patchiness of their earnings, albeit note that over the last 18 months, earnings growth has started trending in the right direction. The results have been more consistent. ANZ delivered its earnings result better than Westpac. As I said, 5% earnings growth, big chunk of that coming from their Asian market strategy. To put some numbers on it, 5.5% dividend yield where it trades at the moment. You've got ANZ, Westpac and NAB coming up to their ex-dividend periods at the moment. I think the banking stocks, in light of what so far have been slightly weaker numbers, I think they're coming back to really sit at sort of this fair value level where they're at the moment. Maybe over the next week, if an opportune time comes to add to the banks ahead of the dividends on any pullback, I think that's a sensible strategy. But otherwise, I really think you're probably in a period for the next 3 months where the banks just go through a bottoming pattern at or near the current valuations. ASX came out with their trading update. Really nothing of great surprise here. On a forward basis, I think the company should still deliver about 5% earnings growth. They reiterated some of their focus on technology spending. I think that probably just helps to underpin the business on a forward basis over the next 2 to 3 years. The market's clearly willing to pay a premium for ASX. I think a big part of that premium is the prospect of a takeover announcement happening in the next year or 2 years, if not sooner. Put some numbers on it. The stock trades on 4.5% yield, which is still attractive dividend yield relative to other areas of the market. The company is only delivering 5% earnings growth. So one would have to say that probably somewhere between $40 and $43 is the range, and it bumps along sideways. Anything above that has to be really put down to a premium in relation to the prospect of a takeover. But we continue to like ASX. We owned it at lower levels. We've taken profit. If an opportunity come along to buy back in at around $40, we'd definitely look to add that back into portfolios for clients where we've taken profit on it already. AZJ, we're significant owners of AZJ. We own it at lower levels. We're buyers around $4.50. We're looking for it to trade up to $5 to $5.25. The strategy there is either to lock in profit at around $5.25 or maybe take that next step up to $5.50 and sell covered calls. AZJ should deliver around 10% earnings growth. The recent haulage numbers the company's announced sort of underline that that's going to be achievable. So we remain pretty comfortable with AZJ and consider that a reasonably core holding within portfolios. In the case of BHP, the forward yield on the stock is running around 5%. Obviously, we'll revisit this in more detail next month when we know the wash up of the South 32 spin-off. In normal circumstances, we'd probably be pretty quick to sell off the shares that are acquired or through the spin-off of a business from the main parent company. I think in this case, the prospect that South 32 may be subject to a takeover, I think we'll be a little more patient and just give the market a benefit of time there to see what ends up happening around the prospect of a takeover for South 32 before we sell off those shares. But generally, BHP, I think at these levels maybe could trade up to 30, the equivalent of sort of another 5 to 10% higher post the South 32 spin-off. So again, we'll revisit that in more detail next week. Brambles. So this is one of those stocks from a technical perspective. It should put in a lower, put in a higher low here at around this sort of 1050 level. I think it becomes a reasonable buying opportunity there. The stock is expensive. It trades on about a 3.4% dividend yield, allowing for about 7 or 8% earnings growth into FY 16. So any strategy there where we're picking the stock up at around this 1050 level on a pullback would be either pretty quick to sell the covered calls on any move back to $11. I think the stock trades sort of between 10.50 and really 11.25. It's hard to see it doing too much more than that, but it's a defensive addition to portfolios and a combination of the dividend and the call option driving 10% cash flow there out of Brambles. CBA. Again, I'll start to sort of focus on some of these technical trends here where we're starting to see a number of stocks pulling back and creating higher lows. So in these quality names, I think they're the ones that we continue to focus on picking up and adding to portfolios. Somewhere around this sort of $86 to $88 level in CBA, I suspect ends up becoming a reasonable buying opportunity, keeping in mind those initial comments where we see the market flat for 3 to 6 months, but a strong recovery or a recovery in the back half of the year off improving US data during the summer. And with that in mind, I think sort of as CBA goes through this bottoming pattern here, it's worth certainly keeping that on the watch list and looking to add that into portfolios. Coca-Cola, in last month's recording, I highlighted that $11 a stock was getting too expensive, and I had a target back to around $9.75. I think we're starting to sort of see Coca-Cola correct back down to, in saying that, $9.75 is strong support, and that's supported by a dividend yield of around 5%. If we assume roughly a 4.5% dividend yield for Coca-Cola, the stock can trade somewhere at around $10.50. So I really think, again, this is one of those names that's correcting, that's broken out to the upside. It's correcting. We'll probably get a structural higher low through here, and it's worth sort of keeping long exposure to Coca-Cola off the back of that. I think we've got every reason to think the upcoming earnings result will stem the losses that we've seen over the past 18 months in Coca-Cola. Computershare, forward earnings at around, puts it on a yield of around 3%. Strong US dollar earnings here, so the benefits from a low Aussie dollar. Again, it's one of those names that's broken out to the upside. Structural low somewhere around this 12 to 12.50 level, I think ends up being a reasonable buying opportunity there for Computershare. CSL, expensive up at these levels, 8 to 10% earnings growth on a 2% dividend yield. Fair value is probably somewhere around $87 or $88. It is at a structural higher low here, so to the extent that we are holders of CSL, we're owning it at or near this value point and selling covered calls just above, see it moving in a fairly tight trading range. Crown Casino, so we've seen Wynns and other US casino groups report gaming results. We're seeing continuing slow numbers out of Macau. Interesting with Crown, on a valuation basis at the moment, on forward earnings, the stock trades at about a 3% dividend yield, about 15 times earnings, and that's allowing for something in the order of about 7% earnings growth for Crown. I'm a little bit cautious over the next few months with Crown. We really want to see an improving picture there in Macau. I suppose the argument is if we wait for that, maybe it's too late in that the price will already recover. From a technical perspective, here at around 13.40, it looks interesting. If it was to break back below that low, I think it's a reason for caution, and Crown probably heads lower. Dexus, looking okay here. These property trusts still, especially in light of yesterday's interest rate cut, I think the property trust names still remain attractive and can probably trade 5% higher than where they're currently trading at the moment over the next 3 months. Fortescue, not doing anything there at present. We've seen them push out the debt liability, so they still owe roughly billion. We've seen them pay a higher interest rate for the benefit of being able to roll that credit due date out roughly 3 years, so it gives them a little bit of reprieve, but obviously very dependent on improving iron ore price to see Fortescue move too much higher from where it is at the moment. Goodman Group, as with all the property plays, looking reasonable from a yield perspective, albeit Goodman's probably the most compressed out of the property play yields, delivering about 8% underlying earnings growth, trading on just under a 4% dividend yield. Again, if we saw a pullback to sort of $6, I think it's a great opportunity to jump into Goodman at a better yield. GPT, still our preferred property play, yielding around 5%. We're buyers of it here at 450, selling the covered calls. GPT and Stocklands and a couple of the others all pay their dividends in June, so just sort of keep that in mind as well. But around this level, I think GPT represents okay value, and we're seeing a structural higher low there in a number of the property trust names. Insurance Australia Group, the natural disasters, I guess, up the eastern seaboard have impacted on forward insurance margins, and we've seen a slight readjustment in the valuation of these names. Still, it puts a stock on about a 6% dividend yield. I think we're buyers of it still down here at around sort of this 550 level. I still think it has the capacity to trade back up to $6 over the next 12 months. And in the meantime, we're getting paid a decent dividend yield for holding it. IPL, bit expensive up here at these levels, compressed back down to a 3% dividend yield. The company should deliver earnings growth maybe somewhere in the order of 15%. 15 to 20%, but when we were owners of it at lower levels, we've taken profit around $3.60, looking for a further pullback before we take another look at IPL. James Hardie, ongoing improvement in the US housing market. The stock trades on a 4.2% dividend yield. Look, it's on the radar, but we're not adding it to portfolios at present. Lendlease, on the other hand, we've been trading this regularly, sort of from buyers at around $15.50, selling out at around $17.50. We've just added Lendlease back into portfolios again. Any pushback up to $17.50, we take profit. Equally, if we see another move back down for clients that are not holding Lendlease at around $15.50, happy to add that into portfolios. Lendlease should deliver, maybe is somewhere in the order of 10 to 12% earnings growth over into FES 16. Mirvac Group, trading on just under a 5% dividend yield, reaffirmed full-year earnings guidance, should deliver earnings per share somewhere around 13-14 cents, or pay out around 10 cents of that in dividends. It's okay value where it sits at the moment. MPL, so we've seen the first half earnings results come out here for MPL, and the market probably got a little bit ahead of itself from a valuation standpoint. I have Medibank Private delivering a yield now at around sort of 3.6% on a full year basis. The first dividend we'll see will be in August. If we go out to FES 16, the stock's starting to creep up to around a 4% dividend yield. I think if we were to see a slightly better back half in the earnings result for Medibank, we should see the stock trade back up to around 230, 240. At that level, we look to sell the 250 covered calls. A combination of the call income and the dividend kicks that yield up to around 8 to 10%, and I think it's a fairly defensive addition to portfolios. Macquarie, I'll leave Macquarie there. We'll wait and see what the earnings results are on Friday, and we'll revisit that in next month's recording. NAB delivers its results on Thursday. I think when you look at sort of where Westpac delivered its numbers, and it's predominantly domestically focused, and ANZ's growth came from Asia, I think the argument is that NAB probably struggles to really outperform market expectation. I think the range for NAB's probably back between $34 and $36.50. Should find support there, puts the stock on about a 6% dividend yield. Newcrest Mining, the positive here is production numbers were very strong, so the company looks like on an annualized basis they'll deliver about 2.5 million ounces of gold, and a slightly improving gold price, and we've seen Newcrest trend higher. I had highlighted back in sort of February there that a structural higher low was being created, and we're looking for a minor breakout. I still believe that there's a reasonable prospect that Newcrest sort of kicks on to that next level and trades up to sort of around $16, $17. And at that point, I think it's worth having a look at selling covered calls over Newcrest. Origin Energy, it's had a good run, and to the extent where we had clients where we'd purchased into Origin at lower levels, we've taken profit here at these levels. I think we get into a consolidation phase now with Origin. I think both Origin and Santos start to deliver better cash flow off the back of these LNG projects that start to ship their first gas reserves. In both cases, the companies carry reasonable amount of debt levels, so I'm not sure over the next year or two that's necessarily going to flow straight into higher dividends for shareholders. I think we'll see the companies look to pay down debt before substantial returns are delivered back to shareholders. But putting aside that we get some consolidation at or near these levels, I think on a 2 to 3 year outlook, there's probably a pretty strong argument that at least Origin is something that you want to sort of keep adding to portfolio. So we keep an eye on this. Any pullback where clients are not holding Origin, we probably look to add that into portfolios. Oil Search. So it's had a reasonable recovery off this low. We tend to hold the stock at levels at around $8. I think if we can sell calls up at around $9 into December, it captures the upside there on Oil Search. QBE Insurance, put some numbers on this. The stock trades at about 4.5% dividend yield. I highlighted that we're going through this sort of breakout pattern where it's creating a higher high. Any pullback to around sort of 12.80, I think, presents a reasonable buying opportunity. The insurance margins are improving slowly for QBE, and the balance sheet's a little bit stronger after their recent 800-odd million capital raising. From an earnings growth standpoint, into 16, the company should deliver, I think, somewhere in the order of around 10 to 12% earnings growth. And that should tie in with a view that we're kind of breaking out into a higher low pattern here on QBE. So it certainly comes onto the radar now. Ramsay Healthcare delivering about 18% underlying earnings growth. First time we've had a pullback for some time. Puts the stock on a 2% dividend yield, still trading very expensive at around 27 times forward earnings. I just highlight that we do have this structural higher low pattern here, and it might be worth just keeping an eye on that relative to sort of other areas of the market, subject to how much sort of selling pressure we get over the days ahead. Rio trades on about a 5.2% dividend yield on FES 16 earnings. That's looking for some earnings uptick in the order of maybe 8 to 10% over the next 12 months. I think Rio, and very obviously dependent on what iron ore prices do. There's a little bit of momentum there at the moment, but at around $60, I think it's probably worth having a look at selling covered calls to add to the cash flow from Rio. But again, our preference is BHP over Rio. In the last recording, I'd sort of had a comment to make on the resource names that I suspect they're going to be range bound and probably offer maybe something in the order of 10 to 15% between support and resistance. We're probably looking at a number a little bit bigger than that, but if you just work on the basis that around 52 support, probably somewhere up at around sort of $70 would be resistance. You know, if you buy her on a pullback at the lower end of that band and you're willing to take profit sort of around that $65 level, I suspect we get a period of 3 to 6 months where BHP, Rio and Woodside Petroleum largely track sideways within that sort of 15% support resistance band. And it may provide probably at least 2 occasions to buy on the dip and sell at the top end of that band over the next 3 to 6 months. So we continue to run that as a strategy that we're keeping an eye on for the larger resource names. Scentre Group within the property trust, still okay value, 5.5% dividend yield here, somewhere at around this 360 to 370. Probably worth having a look at and possibly adding Scentre Group to portfolios where they don't already have a reasonable property trust exposure. SEEK, so this has been added into the top 50 index here, looking for about 20% earnings growth over the 12 months ahead. I think it's too early to add this into portfolios. We continue to analyse the company, look at some of the earnings results coming up, consider competitive forces within the industry and how that impacts SEEK, see how they're responding to it. From a yield perspective, I think sort of at around 15.50 thereabouts might be worth starting to take a closer look at SEEK, but only in the early stages of analysing the benefits of adding that into portfolios and not making any decisions on that at present. Stockland's reaffirmed earnings growth around 7 to 8%. The residential side of the business is contributing strongly to earnings as we expected. Yields around about 5.5%. I think again with all these property names, they're looking interesting, especially in light of yesterday's interest rate cuts. At around sort of $4.50, $4.40, Stockland's becomes interesting again, with a view that the upside's probably again not much more than about 5%. So whether it becomes buying it at or near these levels on the pullback, getting a 5 to 7% rally in the stock and simply taking profit, or going out further, selling the covered call and collecting the dividend as well. Okay, moving, so covered Stocklands. Sonic Healthcare, expensive up here, trading at about 20 times current earnings, about 17 times forward earnings. I'm not sure the company's going to deliver the forward earnings growth that the market's looking for. We own it at lower levels, but we've capped the gains out at around $20. I'm actually looking for Sonic to pull back, and we wouldn't be buyers of it again until it trades at $18.50. That, in my mind, puts the stock back on a yield, trading about 16.5 times earnings on a 4% dividend yield. I think that's fair value, considering we've seen the company's earnings growth come down each quarter or each 6 months. So we've seen them going from delivering sort of 5 to 6% earnings growth to maybe 2%, and I think there's a question mark over the upcoming result, so not willing to chase Sonic. Santos, starting to break out a little. It's one of the first companies that should, well, when I say first, it's likely to beat Origin to shipping its first LNG, and I think that could be a positive catalyst. That's likely to take place in the September quarter, and I think that sort of significantly de-risks the project up at Curtis Island, and I think investors will be somewhat relieved when that happens. In that environment, I think Santos can trade up to maybe around $9 to $10, and we'll have another look at it over the coming months when that happens. All right, so Suncorp. So again, insurance margins have been compressed a little. We've seen these issues or these natural disasters up the eastern seaboard that are pushing the insurance claims up, and we've seen margins sort of slip from 12 to 14% down to around 10%. On a yield basis, Suncorp, and I suppose the impact of that is a lot of investors have been holding Suncorp looking for special dividends. I think we're still likely to probably get a 20-cent special dividend in the 12 months ahead on top of their 91 cents that they're likely to pay out. So from a cash flow perspective, the company's still attractive for yield hunters. At around $13, the stock trades, as I said, close to a 7% dividend yield. I don't think there's too much risk to the top line earnings, even if we say it doesn't deliver the growth that the market's expecting, and we get roughly $1 or $1.02 of earnings per share in FY16, the company's still capable of paying out 91 cents of dividends and maybe a 20-cent special dividend. So I think at around $13, the stock should find support here, trade back up to around $13.50. To the extent that we own it and we don't have covered calls, in most cases, clients, Suncorp shares are capped at around $14.25. So again, if you add the income from that call option into the dividend, it's certainly getting up at around 10% cash flow from owning Suncorp. Transurban, getting expensive up here, puts the stock on a 3.8% dividend yield, looking for about 40 cents of, maybe 42 cents of distributions in FY 16. So you would have to say fair value is probably somewhat just below where it's trading at the moment, back on, say, a 4% dividend yield, which would be back at around that sort of $9.75 to $10 range there. Telstra, we're seeing the yield tick up a little, about 15 cents or 30 cents on a full year basis, puts the stock on a PE of around 17 times forward earnings and about a 5% dividend yield. With yesterday's interest rate cut, I think Telstra coming into the August dividend could easily push back up to that $6.50, and it's a sensible stock to hold in portfolios. Westpac banking result was a little bit disappointed, as I alluded to, but it should find support down here at around this sort of $35 level coming into the upcoming dividend. Wesfarmers, strong numbers, roughly 10% underlying earnings growth from Coles and Bunnings. The stock now compresses back down to a 4.8% dividend yield, and I think therefore its full value should track sideways at or near these levels. Buyers of it on any dip back to $42, but probably up around $45. That's a good reason to lock in some profit. Westfield trades on roughly at $9.25, you're buying it on a 4% dividend yield. On a pushback up to, say, $10.25, you're buying the stock on about a 3.5% dividend yield. So therefore, there's the range. At $9.25 to $9.50 we're buyers. At $10.25, I think it's time to take profit. I think it's likely just to trend sideways within that channel. Woolworths continues to disappoint the market, with seeing earnings come down to that lower range of pretty much flat to maybe 2% earnings growth. But I think the probability of them having any real negative surprise to the downside is pretty limited. Therefore, even if the stock just trades sideways at or near these current levels, you're getting paid about a 4.7% dividend yield. Any rally back up to sort of $32, I think it's an opportune time to sell the covered calls. Woodside Petroleum trading at around a 5% dividend yield, company paying out about 80% of its earnings in dividends. Hard to really get a feel for ultimately what the FY 16 numbers are like as a result of the volatility in the oil prices. But I'm thinking that Woodside Petroleum could deliver, somewhere around 10% earnings growth again in the 12 months ahead. Allowing for that, the stock could trade up to around $36 to $37 as a short-term target. And then finally back to the index. And just to conclude today, so our base view is that probably with the weakness we're seeing in the US at the moment, the index could trade, maybe back down to around 5,700 points. I think at that point, these high quality names within the ASX 50 that have these structural higher highs and higher lows, supported by solid dividend yield, low debt, some level of underlying earnings growth. They're the names that we focus on. We add them into portfolios. We give them an opportunity to rally sort of 5%. In some cases, we'll just take profit and lock that in on the stock. In other cases, we'll go out a little bit further, sell the covered call, and get the benefit of the call option and the dividend income. Thank you for listening in. And if you'd like to know more about the Investor Signal service or have a chat with me about the market in general, please feel free to contact me using the details on screen.